Well, yes, we'll talk about the top trends that are playing out in the banking space. We've had five top private sector banks come out with their numbers, and what do trends look like, and how does FY24 look for some of those key metrics that the banking industry really looks at. So, first off, we'll talk about net interest income. NII has grown faster than loan growth. NII is nothing but the interest income less the interest expense which the bank incurs to earn that interest income. So the net of that amount typically is income, and the higher that amount, the better it is. And therefore, that growing faster than loan growth signifies that certain chunk of the loans are largely floating, which means that as the repo gets repriced, these loans get repriced as well. And as the loans start increasing in terms of their price, and you as a consumer hold these loans, you have to pay a higher EMI or an interest on those loans, and therefore the NII seems to be expanding faster than the loan growth. Otherwise, NII and loan growth ought to be the same in the ideal environment. But at the moment, extremely fast loan growth, and on top of it, NII is growing faster than that. We've seen NII is growing to 30 to 40%, thereby adding to a large chunk of the top line for the banking industry as a whole. What we're also seeing is that banks have increased their operating expenses, which is the operating spends that they make. Thereby, what are they spending on? They're spending on branches and they're spending on technology. These are the two key spends that they are making. This means that they are increasing penetration for their respective brands. So, say for example, an ICICI bank, or say for example, a Kotak bank want to add more branches to try and tap into more customers, so that more customers will come to them for deposits and loans. And that they're doing in this environment, they're finding it conducive because incomes have gone up. So at this point of time, they're willing to invest in both their technology stack as well as branches, both of which are aiding the entire credit cycle that's at play at the moment. Now, coming to provisioning and asset quality. Provisioning is extremely healthy and was extremely healthy at the end of last year, continues to be very, very healthy even now. So what we're seeing is largely provisioning trends are that the number in terms of the provisions is coming far lower than what the street is penciling in. And this is for all banks, except one exception for Q4 was IndusInd Bank. But other than that, all banks largely are reporting below expected numbers in terms of their provisions, which is extremely solid. That means that asset quality is extremely good, very comfortable with all the lending that they've done, and therefore they're not requiring to provide. And also, the existing loans don't seem to have slipped in any major way, and therefore they're not having to provide. So that's on the provisioning and asset quality front. Let's talk about profitability. Now, all of these conditions, therefore, very clearly signify a solid profit growth. So we're seeing largely 30 to 40% after tax profit growth among all these top five banks. We're talking about the likes of HDFC Bank, ICICI Bank, Axis Bank, Kotak Mahindra Bank, and IndusInd Bank. All these five banks are seeing very good tailwind in terms of profitability. What this also does in terms of adding to profitability, it also means that they are able to reinvest the profit back into the business, and thereby not requiring external funding, not requiring to issue debt instruments, and not requiring to push out deposits in a desperate fashion. That's what it really underlines. And coming straight to growth, growth has remained extremely robust. So these banks are having to capitalize on their profits to try and grow better, and that environment is aiding them. So what's happening is the profitability is aiding the growth at the moment, and growth is extremely robust. So we're seeing good solid retail growth. Corporate growth hasn't seen a significant pickup yet. Of course, it's picked up, but not in a meaningful fashion. So we're still awaiting the corporate cycle to pick up, that is companies to start borrowing. But on the retail side, borrowing is quite robust. We're seeing an average of 15.5% over the last quarter in terms of growth in the system, in the banking system as a whole. So which is extremely solid. And some of these banks are growing at much faster than that, 20%, 17%, 18%, which means that they're investing back into their business in terms of growth as well, which will mean profits later on, of course. So that's on the advances front. We're seeing good solid growth in advances. In terms of deposits as well, we're seeing good growth in deposits starting to pick up. All this while, till the end of Q3 of FY23, we weren't seeing a significant pickup in deposits. We're seeing only 1 or 2 banks being able to pick up deposits well. Now we're seeing a whole lot more of banks entering the competition, and they're starting to pick up on the deposit growth front. Mind you, till you don't get deposits, you can't grow loans purely on the basis of profits. So they have to pick up deposits, and that's exactly what most banks are now starting to do. We're starting to see good strong trends, 15% plus growth in deposits in a large chunk of the banks. Of course, a few banks still trailing, but they too will pick up as FY24 picks up. As FY24 picks up, NIIs are expected to start to peak, and therefore they'll start to come off in FY24. Profitability also will start to flatten out on a very high base of FY23. We're also expecting to see loan growth on a high base of FY23 expected to stay flat, that is around the 12 to 15% mark, and we're also expecting that deposit growth will see a bit of a bump up on a lower base. So these are the large trends that are playing out, and that's largely on the back of all the management commentary we've been putting together.
If you like this video, then like, share and subscribe to ET Now.